We are recording this webinar to make sure everyone sees what's going on and catch the replay if you have any questions. There's a chat box in the bottom of your screen. With that chat box, you can send me or Shante a message. We will be monitoring everything in there. If you have any particular questions for the guests, they will provide their information later in the video. So without ado, Shante, why don't you introduce everybody?
Hello, everybody, and thank you for joining us on this lovely Monday evening. My name is Shante Duffy, and I work with Madison Management Services, a loan servicing company based out of now Reno, Nevada. Been there for about 6 years now, and I'm excited to talk to you guys all about force-based insurance with the rest of the crew. So welcome.
Awesome. Next, we have Erin Quinn.
Oh, I have to introduce myself too, huh? All right. I'm Erin Quinn. I'm based in Clearwater, Florida. I'm an attorney. I've specialized in representing creditors in their foreclosure and bankruptcy endeavors since 2002, first as a legal assistant and then as an attorney. I got my Georgia license 3 years ago and now represent creditors in Georgia as well. I opened my small law office with my partner and mentor of 17 years, Robert Bowen, about a year ago today. So that's pretty exciting. We're moving right along, and we've got some good help here as well. So that's kind of, I guess, all that you really need to know. The reason, I guess, for my involvement here tonight is mainly to answer any legal questions you guys have with respect to potential claims, and then also Dave invited me to explain some different addendums that I've been able to create for some of the documents and the sales that he's had to avoid any loss in the sale process.
And we have Beth.
Hi there. I'm Beth Boisseau. I'm with JB Lloyd & Associates. We're an insurance broker who specializes in financial institution, lenders, and real estate investors. So we've worked with quite a number of investors. We work all over the country, and we represent a number of different carriers. Dave invited me to be on here to answer coverage questions. I know there's a lot of them, a lot of confusion about the different types of coverage and policies, about what co-insurance is. So I'm really looking forward to fielding some of the questions.
And last but not least, Gretchen.
Hi, my name is Gretchan Francis. I'm with Proctor Financial. We're a lender-placed insurance provider based out of Troy, Michigan. I've been in the insurance industry nearly 10 years. Prior to that, I was with a local lender, and I recently obtained my certified insurance counselor license, and I'm happy to be here tonight.
Wonderful. As before, I'm Dave Putz from JKP Holdings. I'm excited about this webinar. This is a topic that I don't know a lot about, which is awesome, and I'm excited to get started. As we talked before, this is force-placed / lenders-placed insurance, and it's something that we all probably use and all should use, as well as all don't have a clue what it all means or what it does, and just complain later how it doesn't work for us. So what we're looking to do tonight is really to nail down some of the questions we have to really focus on what we should be doing and maybe some changes that will help our business, and so we don't get stuck in situations we shouldn't be in. So just to start off with, I like Gretchen, if you can share a little more about force-placed insurance, lenders-placed insurance, and let's start off with buying a policy.
Sure. Okay. So lender-placed insurance or force-placed insurance is an insurance policy that a lender would buy when a borrower does not fulfill their agreement to maintain property insurance on a property. So typically the lending documents state that the borrower has to maintain a certain level of insurance. It dictates the insured amount, the type of coverage, whether you need flood or just property insurance. And of course, when the borrower doesn't maintain that insurance, then the lender is forced to buy what would be a replacement coverage, otherwise called lender-placed insurance. Often it is more expensive, so it does behoove the borrower to keep their own insurance in place. But when that's not, when that doesn't occur, then lender-placed insurance becomes necessary. So you can buy lender-placed insurance in a couple of different ways. You can purchase it either as a standalone policy. So if you're a lender that maybe only has 1 or 2 borrowers that don't maintain their own insurance, then you can buy it as a standalone policy. Or if you have multiple properties within your lending portfolio that need coverage, you can buy a master policy, which is it offers a lot of ease of administration for clients, because they can add and remove properties for coverage at any time, and they would only pay a per diem premium. So let's say they add a property today, and then the borrower comes in and gets their own policy, then the lender can go ahead and cancel that.
Awesome. I do think that a lot of people want to know, can most of these policies be converted to REO, which we'll get into. Can most of these policies be converted from a lender's place to an REO if something goes through foreclosure auction?
They can. Some of our clients, it's a very streamlined transition. So some of our clients, they do transition from lender place right to REO. There would be a date of, that it would occur. So we would keep track of what day that would transfer from lender place over to REO. Typically, when it turns over to REO, you're going to want to buy liability insurance with that property coverage. Typically, lenders don't buy liability coverage when it's just lender placed, but when it turns over to REO, they would certainly want to buy that liability coverage.
Okay. Beth, I know we talked briefly about some different forms, right? Before I didn't know about this, is a basic and a special form. Can you give us what that means in layman's terms?
Sure. So a basic form is going to cover only what is listed on the policy. Typically, it is the 5 basic perils. A policy can be endorsed for more, but it is only what is listed is going to be covered. Special form or an all-risk form is going to cover everything except what is listed as an exclusion. Obviously, the coverage on a special form is going to be much more broad because, again, everything's covered unless it's specifically excluded.
Is there something specific that any kind of examples you can give of what someone's done on a special form or a basic form, or what do we typically use as note investors?
Well, it depends. So note investors, sometimes if they're only wanting, a real basic, they want to cover their interest in the property, maybe what they bought the asset for, and they're not real they want the lowest price, but they want some minimum coverage. They're going to go with a DP1, which is usually a basic form, and is going to cover the 5 basic perils. Plus, usually it's endorsed for theft and vandalism. Okay. That would be an example of a lender or an investor wanting to go with the basic form. Then there's other times where an investor will want to go with a special form, and that's often like if they're doing a lot of buy and holds, or if they're doing fix and flips, and they need a little bit more broad coverage because their investment is a little larger. Okay. And they're willing to pay a little more for that.
Okay. This got me into a little issue recently. Gretchen, can you share what RCV and ACV is and what the difference is, and how does that in fact impact our investment knowledge or experience?
You got it. Us insurance folks, we love to have acronyms for everything. And we can just kind of, spit them off the top of our tongue, and nobody knows what we're talking about. So RCV means replacement cost value. So replacement cost would be exactly that. The cost that it would take to literally rebuild a house or a property, nail by nail, brick by brick. That's the replacement cost. If anyone out there has ever built a home, you know how expensive it can be to rebuild or to build a home, let alone rebuild a home. Replacement cost value is often much more expensive than a market value, for example. You could often go and buy a home cheaper than you could rebuild a home for. ACV would be actual cash value, another insurance term, and that is the depreciated value of the home. So think of it like, let's say, a roof. You put a new roof on your house, it costs $20,000, and it's supposed to last 20 years. Well, every year it would depreciate approximately $1,000. So if you have a loss on your roof and you're getting paid ACV, or actual cash value, they're going to look at the cost of the roof, $20,000, the number of years you've had the roof. So if you've had it 5 years, they're going to depreciate that roof by $5,000 and give you the remainder, which would, let's say $15,000. Now, unfortunately, that means you're going to have to come up with the difference, because you can't go and tell your roofer, well, I only got $15,000 on my insurance claim, so can you give me a $15,000 roof? They're going to say, well, no, a new roof costs $20,000.
Mm-hmm.
So ACV is a depreciated value. Now, when you're insuring a home or a property, you can insure for either value. Well, you can insure for either value unless the lender would stipulate what type of coverage you would need. Replacement cost is a higher value. If there's a loss, you're going to get a higher return. So your claim payment is going to be a higher value.
Mm-hmm.
ACV is going to be a much lower value. Now, keep in mind, you don't want to mistake either of these with market value. Market value is a completely separate value, and that has to do with the value of the home that you could buy or sell the home for. It has nothing to do with insurance.
Okay. So I know, Beth, we talked about this in the deal we're dealing with out in Ohio. How does this affect note buyers when maybe they listed it wrong, or they could, the pro and con? Obviously, sometimes it's benefit to do the cash value, the replace value, and sometimes not. Can you share how that may affect the claim that someone files?
Well, okay, so to break that up into two parts, the ACV, the pros would be that you're paying a lesser premium. Con would be you get a lesser settlement at the time of a claim. Placement costs, you pay a higher premium, but the benefit would be at the time of a claim, you get a larger settlement.
Mm-hmm.
It's really all goes back to an investor's risk tolerance and how much they want to self-insure, how much they're comfortable self-insuring. So that would be, I guess, the answer to the first part of your question. In terms of, which would be the better option, I mean, again, it kind of goes back to those pros and cons, and it depends on, the appetite of the investor.
What happens if you don't put it high enough? What could happen if we have a $150,000 house and we put a value of $80,000? What could happen?
Well, a coinsurance penalty could kick in.
So what's a coinsurance penalty?
So coinsurance, very misunderstood term, that is the insured is required to purchase a specified amount of insurance based on, so it'd be a percentage of the replacement cost. So it's typically 80, 90, or 100%. So for example, if the replacement cost is $100,000 and the coinsurance clause specified that the insured must have at least 80% of that, they would need to be insuring that property for a minimum of $80,000.
And then $100,000 is based on buildable, the ACV, or RCV?
That would be based on RC, the replacement cost.
Okay.
Which it varies. There's a valuation tool insurers use to come up with a specific number. With my carriers, I kind of have a feel for what their sweet spot is, so I can advise on that. But it is not an exact science. but
So-
it is a cost to rebuild per square foot.
So most people, investors, typically base their liability on what the UPB is sometimes, or how much money we have in the deal. And it
Right.
sounds to me that if you do one of those two and then not high enough, you could have a problem with your claim.
Depends on the type of policy you have. If you have a DP1,
What's DP1 mean?
it's a form. We have forms in this industry. And so all insurance agreements are contracts, and the contracts they're called forms, the different types of insurance contracts. So DP1 is one type of form, which that one allows the investor to insure their property for what they have invested in it without any coinsurance penalty. The coverage is not as good, but there is coverage in place, and they're not paying as high a premium because they're not insuring for the full replacement cost. A DP3 would allow the insured to cover it for replacement cost, but if they did not, then there would be the coinsurance penalty that would kick in at the time of a claim. So, I don't want to get too far in the weeds with that here, but it is important when a real estate investor is shopping for coverage to walk through the types of forms and what that means to them, how they cover the property, if there's coinsurance, what the deductible is, and if it's a special form or a basic form.
So it sounds to me, Gretchen, that we make that choice as an investor what kind of form we want, as long as we know what we're looking for. Correct?
Right. And there's not only different forms, but there's different names for the same form. So some insurance companies might call it a named perils form. Some might call it an all risk form. If you have a good insurance agent, they're going to be able to explain it to you. But if you don't, we don't expect our clients to know insurance. That's why we're here. So if you don't know what it means or what a term means, just ask and keep asking questions until you understand.
Cool. Shante, do we have a choice from Madison's point of view when we get insurance through a servicer?
Madison actually has an umbrella policy through Gretchen, you and your team with Proctor. And these are things that I'm going to be honest with you guys, I had no idea. So I promise you I will find out. We don't have a choice right now, though. It's whatever Madison set up. But now I have some digging to do to make sure that we have something that works for all you guys as investors.
Awesome.
In your favor. I don't want to give you guys anything bad.
So, Drew, just quickly answer your question. I saw you in the chat. Yes, if you underestimate the value of the property, you can lose out on a claim because you're not high enough. So we definitely have them elaborate more on that, but we want to get through all the questions. But yes, you can get penalized. Go ahead, Gretchen.
Dave, can I just, I see Dave's question there. So it's not that the investor gets penalized, it's that they get paid for the amount of coverage that they purchased. Because you could look at it the opposite way. The majority of claims are paid in the very low dollar amount. So let's say it's a $100,000 house. The majority of claims are not complete loss claims. They're often paid in the lower, the lower value, under $10,000, let's say. And so if you're not paying for the entire value of the home, then you're paying less premium than you should really be paying. And so in that instance, it's the insurance company that's kind of getting penalized on the premium. So the insurance company wants you to pay the premium for the property, and then they will pay the full claim, of course, when a claim occurs. So it's not that insurance companies are trying to penalize in the course of a claim. They're just trying to get the appropriate premium for the appropriate claims that are expected to be paid out.
Cool. All right.
Roger actually does bring up a good point about contracts for deeds, which are coming back in full force, to my dismay in my life. But in a CFD situation, you guys are technically the owners of record of the property, and liability insurance is very important in that situation. So where you would normally get a lender's policy if you're going to go the traditional note and mortgage route, and you're just going to be a lien on that property rather than the actual owner, getting an insurance policy from a lender-placed basis as opposed to an owner basis is important. But if you're doing those contracts for deeds, agreement for deeds, making sure that you're getting that liability coverage as an owner of record is important too. If a dog bites somebody on that property and you have a CFD, you're responsible. And you're going to have the tough time in court, trying to prove otherwise when you are the actual owner of record on that property.
And Bob, I see your question. We're going to get into that in a little while. It's one of our things we're going to definitely talk about. So the next part of buying a policy is this claims made versus occurrence. I posted about it in my Facebook group. I've been frustrated with it. I've gotten screwed by it, and I've learned from it. So
what's the difference?
Yeah. So, and Erin's well versed in this now after having many talks. Beth, I'll let you kind of start off with this. What is claims made, generally speaking, and what's occurrence, and what do we typically, how does that affect us?
Well, if it is an occurrence policy, then if, let's say you have a roof and it needs to be replaced, and let's say it happened prior to the current policy, it happened when you had a different policy, you can go back to that because it's occurrence, and you can make a claim on the old policy and we'll still pay.
So the seller's policy, you mean? Someone else's policy, you can file a claim on theirs.
You cannot file a claim, somebody else can. So if you, let's say you buy this asset from John Doe, and you realize after the fact that there was a roof claim. If John Doe, who had the policy prior to you purchasing the asset, he could file a claim on his policy, but you could not because you would not be named insured.
Okay.
With a claims made policy, it has to happen within the policy period of that insurance contract.
And what happens if you do find out it didn't happen, it happened before you bought it? Can you do anything about that? When claims made?
No.
So that's a big one.
It is a very big one. And it really, what Erin's doing with putting some verbiage in the contract is helpful. But it really comes down to do as much due diligence as you can when purchasing these assets. Because if you purchase one and there's a hole in the roof and, disaster everywhere and you didn't know it, that's, you can't file that on the new policy that you got when you purchased that asset.
Erin, you want to speak legally about that? What you've tried putting together to kind of do your best to help protect us?
Sure. So after many a minute of conversation with Beth on the difference between and trying to understand the differences between and what basically the ramifications would be for you taking on a policy, obviously your best practice is going to be to find out what type of insurance policy is on the property at that time. So if the borrower still keeps their insurance, awesome. If they haven't and there is an FPI policy, a forced place insurance policy on the property, then it's in your best interest to figure out what type of policy that is. And the reason being is because it could determine whether or not you buy the asset at all. Because if it is the type of policy where it terminates upon the sale to the new investor, and then you find out that there's there's roof damage that occurred before you purchased the asset, that's a big deal. A roof is a big deal. So making sure that you're aware of what type of policy is there is important. And so what I did for Dave is just tried to structure a addendum to his purchase and sale agreements that allows him to attempt to obtain those disclosures prior to the purchase of the loan during the due diligence process. We all know that doesn't always happen. Sometimes it's a blanket policy. It just depends on the situation and what the seller is willing to give. So, in addition to the disclosure of the type of policy, I also suggested in that addendum that any known damage to the property be disclosed through property inspection. So obviously you guys are going to do kind of your own inspections, which hopefully my husband might have something ready for you guys with drones at one point with that, but we'll talk about that another time. And, you know, just to kind of mitigate those potential losses with respect to unpermitted structures on the back of the house or, you know, roof damage, et cetera.
Awesome.
So in the event that there is damage to the property that the lender, the seller knew or should have known about before selling you the loan, and now you are unable to make that claim, they have to make you whole for that. Either they have to pay out the cost of the damage, or potentially they have to buy back the loan. And then also it gives the buyer the ability to waive the requirements of that. So if you decide, you know what, yeah, it's got a roof leak, but the property's worth so much money that I'm willing to keep it, then you have that that ability. The last thing that, go ahead.
Can this webinar get a hold of you afterwards and actually get you to pass along the addendum for a fee, Erin?
Yes, of course, yes.
Awesome.
And then the last thing is just seller cooperation, and making sure that, you know, the seller's not like, yeah, I'll totally help you with that after it's over. And then, you know, you get to the point where you have a claim and that you have, you know, you're looking for a reimbursement. And I believe it was Beth was saying how sometimes the reimbursement's going to go back to the seller instead of to you as the buyer, because the seller was the one that had the policy. So in those instances, making sure that that reimbursement gets back to you as the new owner of the property, that addendum just kind of puts some teeth into it to force them to try to turn over that money when it's time, so that you can, you know, do the necessary repairs to the property. So that's kind of the gist of it. I don't want to keep a lot of time, but I do have the addendum, and I'm, you know, happy to answer questions at any time.
Thank you so much.
Right.
So the next one is like when we actually have a claim and we have to file one. We're scared. We don't know what to do. Step one is freak out or what?
Definitely. Kidding.
Gretchen, what would you say your first step is investor when you find out? Hide it. Don't tell anyone. Hope it goes away.
No.
Go on, you're up.
No, you know, certainly when you discover a claim or a potential claim, you want to and you're required to report it as soon as possible. Actually, in the policy, there's certain conditions that you have to meet. One is to prevent further damage from the home. So if that means, you know, the home's on fire, guess what? You got to call the fire department. You got to notify somebody. You have to try to minimize damage in some respects. If there's, you know, a hole in the roof, you should try to get somebody out there, not necessarily to repair it, but to cover the hole so that further water damage doesn't occur. So you do have to try to minimize damage and then report it as quickly as possible. When you report it, you're going to kind of have a good idea or somewhat of an idea of what happened, whether it was a tree that fell on the home, a kitchen fire, a burst pipe. So when you make the claim, you're going to kind of give an idea of, okay, you know, I've got water in my house, or there's a tree that fell in the house. But it's really up to an adjuster to come out and inspect the property to determine the true cause of loss. And then also they would determine how much coverage that you would have. What you don't want to do is make repairs, final repairs, until somebody's been out to look at the property and document the damage. Because let's say you have a kitchen fire, and let's say you work in construction and you just start fixing it, and then a month later you go to your insurance and you say, well, I had a kitchen fire and I've already fixed it, and now I want you to pay me for it. They're going to say, well, we don't see any damage. So you want an adjuster to come out as quickly as possible. Typically when you contact, I know with us, with our claims department, when you contact us and you file a claim, we have independent adjusters around the country. So we would send out our independent adjusters who would be at your location. Typically it's within 72 hours. So it's within a very short period of time. And then once the damage is documented, then you can kind of start doing some repairs, but at least we've documented what the damage was.
Okay, awesome. Shante, what's your experience with investors calling you up freaking out?
It's definitely intimidating. We actually don't file the claims for the investors. We actually put them in contact with Proctor directly. And I haven't heard any complaints. I just kind of tell them, hey, everyone's been pretty awesome when I deal with them. I've never had to file a claim on anything, so I don't understand the entire process, start to finish, and how it works and physically being in those shoes. But I know you can, or we've run into some hiccups in some things. What happens when you file a claim while a loan is in foreclosure? And Erin, I'm going to ask you that.
Well, I think that it depends. To a certain extent, it's going to depend on the state. So judicial state, for instance, in Florida, what will usually happen if the property is destroyed during the course of the foreclosure is the foreclosure will continue, but the borrower and the towards resolution of the insurance claim, usually in conjunction. If it's a forced place policy, then obviously it's going to end up being the lender that does that. What usually occurs in those situations is that once the amount of damage is agreed upon, or once the lender accepts, let's just say they say, the insurance company comes back and says, yeah, it's only a $50,000 loss, so I'm going to give you $50,000. You as the lender might say, well, wait a second, it's decreasing the value by $75,000, or it's a $1,000 problem. So you have kind of a disconnect as to what the insurance company will actually pay. In that instance, it can go, depending on the actual contract, the actual insurance contract, it can go to either arbitration or mediation. It can be the subject of a separate suit, wherein the foreclosure kind of stays on hold while that happens. And it is very situational in the sense that you as the lender might proceed with a foreclosure claim, for instance, if it's a complaint filing and we're just getting service of process rolling, versus the sale is in 2 weeks and now you have a property that's deteriorated in value and you're potentially not going to have as good of bidding competition on the property. So usually what happens is once the check is issued, aside from just the normal who's going to sign, et cetera, it gets placed in escrow or in suspense until those proceeds are determined how they're going to be handled. So most mortgage contracts, especially the Fannie Mae, Freddie Mac forms, actually allow the lender to make a determination on whether they are going to allow the borrower to actually restore the condition of the home, or if the home is too far gone, then that amount would be placed towards the debt itself, and basically as a partial payoff of the debt of the property, and that's at the lender's discretion. Okay. So this is not a question to be answered about CFD. Different, and they're really not playing out significantly in at least Florida because they're treated as mortgages here right now. In Georgia, for instance, under the security deed, you have generally those same situations happening. So again, it's really just going to depend. What are the terms of your insurance contract, making sure that the servicer places that in suspense or in escrow until they receive some type of authorization on how to handle those funds, and then whether those are doled out directly to the contractor or paid to the borrower to repair the home, or to pay down the principal balance and given to the lender.
Awesome. So if a borrower is non-occupying the home, we can't contact, can we file a suit in court and just get in the house and do all the repairs? Would that cause any problems in the foreclosure process?
You actually don't have a suit in order to conduct repairs on the property. And this is, again, going to be situationally dependent on the contracts itself. In a note and mortgage, again, using the Fannie Mae, Freddie Mac forms, it's going to actually indicate in those forms that you as the lender have the right to protect that collateral. So if it means filing insurance claims, if that means, force repairing a property, if that means bringing the property up to code, if that means, shutting off the water because of a flood, whatever that is, you have, if the borrower is not cooperating, you have the right to go in there to do that, to protect your collateral interest in the property. So as a secured transaction for you guys, it's actually kind of a best case scenario because you have the ability to protect your investment just like the borrower does. Again, there are some notice provisions around that. Again, they're all in the contract. For the most part, at least in my states, in Florida and Georgia, everything is very contractually based. And the contract will tell you exactly what you can or can't do.
Wow.
And just to add to that, if it's in foreclosure, there would be a difference if it's the borrower that has maintained their insurance coverage or if it's actually in forced place coverage. If it's in forced place coverage, the claim proceeds are going to go directly to the lender in the lender's name. So they're going to have full access and availability of those funds to make any repairs. If it happens to be that the borrower still has their insurance, which I don't know if they're in foreclosure, I don't know why they would still maintain their insurance, but perhaps their insurance policy is still in force, then a claims check would come in the name of the borrower as well as the mortgagee. And that could be a little more difficult for the lender to then disperse those funds because they're going to have to get the check, they're going to have the borrower sign the check, then they're going to have to manage those proceeds. And then it becomes a question of who's going to do the repairs. Do we trust the borrower to do the repairs? They're in foreclosure. Or does the bank or the lender then take over?
Gotcha. So,
just to add to that too, in the judicial states for sure, that's a simple motion to compel the signature of the borrowers on the insurance proceeds check if they're not willing to sign it. The bank in most situations is allowed to keep those funds in suspense, pending each milestone of the repair of the property. And so for the most part, that's a simple motion there. In a non-judicial state, it's obviously going to be a little bit more difficult because generally you have to file suit instead of the non-judicial route. But I think that for the most part, you can get those done fairly quickly through, especially in an emergency situation where you have a deterioration of the property.
Can I add one thing here? I don't think that we addressed this earlier, and I just want to point out to those who are on this podcast, there is a slight difference between a forced place / foreclosed policy and a real estate investor policy. They're very similar, but there is a difference. So when we talk about this, I saw some questions in chat and I'm hearing, what we're addressing right now is traditional forced place policy, which if you have that policy and the status changes from a borrower lapse of insurance to a foreclosure situation, you have to go into foreclosure. You simply go online, you change the status of the property, and then liability is added because you don't need liability if you're only forcing. That liability exposure is still on the borrower. But a real estate investor policy, while very, very similar to a forced place policy, typically it adds liability across the board. Because as a real estate investor, usually in 9 out of 10 cases, there is a liability exposure. So I wanted to make that very important distinction. So that, again, people can go into this when they're shopping for insurance more informed. Know that they're very similar, but there is a difference.
That's true. So, Beth, I want to also ask you about, when you file a claim, the money comes in, can I hold it till I foreclose on it so I don't do any repairs? I don't want the homeowner living in some great house and I just repaired. Can I hold that money till the end?
Well, one of our favorite sayings is in insurance is it depends. It depends on the policy and the verbiage in the policy. Some of my carriers have verbiage in there that states you have replacement cost settlement, but if you wait 180 days, if you go past that before doing repairs, that settlement changes from a replacement cost settlement to an actual cash value settlement.
Whoa.
And to remind everybody, actual cash value settlement means you take replacement cost, deduct depreciation, and that is your settlement less the deductible and any coinsurance. So obviously that could really impact the settlement. So it's real important to know your policy and know if there's a stipulation like that. So to your question, it depends. It depends on the policy. You can, but just know it may impact the final settlement.
Gotcha. I ran into this question multiple times. Sending out these the FPI letters, I know that some of our attendees asked this question, and I've asked this question. Are there certain letters and timeframes that if we're going to send out start the FPI policy on somebody, is there policies that instated in law, I'm trying to beat on the bush here, that we have to put in place in the timeframes, Gretchen, that we have to file them, and when to file them, and when we can file them, when we could charge the lender for those things? Can you explain a little bit about that?
Yes, there is a series of letters that is required to be sent by U.S. mail to the borrower within a specified period of time. The first notification has to be sent when you know that there's a lapse of preferred insurance. So when you become aware that there's insurance that that the borrower has not maintained, you're required to send a letter to the borrower to notify them. Then 30 days later, you have to send essentially the same letter if you haven't gotten insurance, proof of insurance from the borrower. And then 15 days after that, you can send the third letter, which would be the bind notification, basically saying that you have now forced placed coverage. So those series of 3 letters have to be sent within 45 days. And then you can proceed with forced placing and charging the borrower. Now, if the borrower comes up with their preferred insurance, with their own insurance, and they say, oh, I just ignored your letters until you actually charged me money, but looky here, I have my insurance and it's been in place the entire time, you can do what's called a flat cancel of that insurance. And that would cancel the insurance, backdate it, and cancel it, and it would cancel any premium that was due.
So we could put insurance in place, we just can't charge until the letters are written out. Is that correct?
Correct. That's correct. And most lender-placed providers do have that kind of built in. If there's an online system, they have it built into their online system. If they have a billing method, they have it built into their billing method. For example, we can do up to 60 days retroactive billing. And probably Beth, you guys do that, or whoever, whatever carriers you're working with can do that. Because we know that lenders have a need for insurance right now, even though they can't necessarily pay for it right now. They need that period of time to send out the notifications.
And I know, Beth, you shared these letters with me. Is this something that we can share with the group here that we can add on to our follow-up email tomorrow, that we can kind of give a general letter, what they get to give out in time frames? Is this something you can get over to me?
I can send you the CFPB model letter forms.
Awesome.
You can share them.
Cool.
To add on to what Gretchen said, in terms of doing a flat cancel, just, I know this sounds pretty common sense, but just note that you as the lender can't just take their word for it. You need to see an actual proof that they had the insurance before you flat cancel. And then your insurer also has to have that before they will flat cancel. So just, again, I know it's common sense, but.
Agreed.
Do you guys require just the deck page for that, the declarations page, or do you want a full copy of the policy?
Deck page is plenty.
Okay.
Yeah.
Just a couple side things, and we're getting to some of the other questions here. We've run into mold and fungus issues in the past, and I've been typically told mold and fungus isn't covered at all, and typically is a problem. Is there circumstances where mold, fungus can be covered due to a result of what happened?
Yes.
Good, Beth. Good. What would you say is a scenario that mold will be covered?
If the mold is a result of something that is a covered peril under the policy. So if your tree falls through the roof, and it's caused, and again, a lot of this is going to be dependent. If you haven't taken the proper care, and then the mold comes from that, but you as the insured did not follow the protocol as outlined in the policy to secure the property, and therefore mold resulted, that would not be covered. But if that type of thing comes from a covered peril, then it would be covered.
Okay, awesome. Does this also include flood insurance? Is Lender's Place Insurance cover flood insurance at all, Gretchen?
Flood insurance is typically purchased separate from property insurance. And when I say property insurance, I mean hazard insurance. Not every property requires flood insurance. There are certain properties that are in the high risk flood zones that lenders do require flood insurance, but certainly not every property. So flood is available. You can force place it, but it's typically a separate policy, let's say. And actually, sometimes we do run into instances where a borrower has maintained their homeowner's insurance, but they just haven't maintained their flood insurance. Or maybe the flood zone changes, there's remaps, and so maybe the flood zone changes, and they were previously not required to purchase flood insurance, but now they are, and they're not aware of it. So then sometimes forced place flood needs to be purchased.
Okay, so we can get forced place flood, and that's something obviously we go through you guys to figure out if we do or don't need it.
I think
Right.
that with Proctor, it's probably similar, but we can add that anytime. It's the standard national flood rates, and then it's seamless on the online reporting system. You just add, you have a drop down and you select flood.
Cool.
It's a very easy process.
Yeah, and flood rates are typically standard across the board, depending on the type of property, the flood zone. There's not a lot of underwriting that goes into flood rates. So don't bother shopping around for better flood rates, because they're all pretty standard rates.
Cool. So
I actually do have a question about flood insurance that I think is relevant here. And I know that on my house, although I'm in a non-flood zone, I actually maintain flood insurance at the tune of like $360 a year or something. And it was recommended to me because there are certain things that are not covered by hazard that you would think would be covered by hazard, that end up being under like more of a flood risk, for instance, like broken pipes or something like that. Is it something that you guys, for the minimal cost that it is in a forced place situation, would you recommend that they keep flood insurance even outside of a flood zone for any particular reason?
Well, first of all, broken pipes are not flood, but I know you were just saying that like as an example of a potential flood. Yeah. So everybody's in a flood zone. It's just a matter of if you're in a high risk flood zone or a low risk flood zone. So everybody has some zone attached to their property. And it's only the high risk ones that require flood insurance by lenders.
Mm-hmm.
If you're in a low risk zone that does not require flood insurance, then it is very cheap because it's obviously very low risk. So yes, I think it's absolutely worth the extra $300 or so it costs you per year. I would personally on my own home do the same thing. But yeah.
There were a lot of people in Houston about 2 years ago that wished that they had done that. A lot of those people that were completely devastated by Hurricane Harvey were not in flood zones, and yet their properties flooded And so it was a bad situation.
Cool.
Quickly, we have a question from Drew. He would like to know if we need private adjusters to guide and protect us as lenders, or can we count on our insurance agents to help us get the coverage that we purchased?
That's a great question. Every insurance company operates differently. Some insurance companies have their own adjusters. I know I previously had a homeowner's policy with State Farm. As far as I know, State Farm has their own adjusters, meaning they're sending their own people out to adjust the property. Now, you can see how that could be a conflict of interest. Why would they be looking to pay more, more money on a claim? They would actually probably be looking to pay less. With Proctor, we use independent adjusters. And our adjusters that we use, it's a network of independent adjusters. They are not affiliated with us whatsoever. They're actually paid a percentage of claimable damage that they find. So they're incented to find more damage because then they get paid more. I can't speak for every insurance company, but there is a difference when it comes to adjusters. So you could ask your carrier or your insurance agent, are these independent adjusters or are they affiliated with the insurance company?
It's good to know. What do lenders need to do or are required to do when a loan turns into an REO and we have to change that insurance policy that we have? What are the steps that us as lenders have to take, if there are any? Is it as simple as, hey, I just need to switch? What changes?
Online, you just simply go and change the status from forced place to foreclosed.
Does it change? Go into of that?
Say it again.
And then you're going to want to, I don't know if you have a separate step, Beth, or not, but you would want to make sure you add liability at that point.
Yeah, ours is automatically added. Even with all of our carriers across the board, we have one online system. So anytime that status would change, it would be automatically added. But she's right. If you are working, you'd want to check with your carrier to make sure that the liability was added.
Perfect.
So we talked before about inspections and stuff like that. Can you guys give me some things of inspections and checklists of things that investors should do to kind of, is there a generic checklist that we can get a hold of that we can go down and say, check, 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 and what is we should be looking at for filing a claim and what could be claimable and all that kind of stuff? Is there any kind of checklist that we can use?
In terms of like what's covered, what's not covered?
I guess sometimes we don't know what we can file a claim on, what we can't file a claim on, right? Is there a kind of a overall checklist like, yep, check the air conditioning unit, nope, check the graffiti, check the floors?
I don't know of one, but I mean, other than the insurance policy itself, obviously that's a cumbersome checklist that nobody really wants to go through, but it does have all those items. But I don't know of one separate. Gretchen, do you know of an independent checklist that?
No, but I would say if in doubt, if you're wondering if a potential damage could be claimed, I would say just claim it, because it doesn't cost anything to file a claim. And if there's a potential loss that could be covered, let us come out, let us look at it, and if it's covered, then you're going to get paid for it. But if it's not, then okay, there was no loss to do the claim.
No harm, no.
Yeah. So, but when it comes to a checklist of actually doing a claim, really, I mean, I don't have one, but I know when you call our claims department, for example, they certainly have their checklist. They say, okay, I need you to do this, I need you to do that. I'm going to send an adjuster out within so many days. Then we're going to send you a file. I know with our lender clients, we have all of our claims information online, so they can look at adjusters' reports. They can see if there's any forms that need to be signed or returned. Typically, we need a proof of loss signed before we release funds. So really, I think it's just a matter of following, the whoever you're working with in the claims department.
So I did see a question that and I'm going to bring up one thing, and I'm going to just quickly route to the question. We said offline that if we're going to file a claim, we should make it as broad as possible. Don't say there's flood in the basement. Just say there's flood damage, and keep that broad. I think we talked about offline to kind of keep it as broad as possible to do a catch-all. So let's remind everyone that that was a conversation we had offline last week. When you do file something, try being as broader than you can be, just so that it covers everything. If we file claims, what happens to our premiums? We get in too many car accidents, our car insurance goes up. We file too many claims with our house insurance goes up. If we're investors and we have a bunch of properties and we start filing claims, what happens to our premiums?
Well, it's not how many claims you file, it's how many claims are actually paid out.
Mm-hmm.
So if you file 10 claims and we come and say, no, that's wear and tear, the roof wasn't damaged, it's just, it's a 20-year-old roof, you just need to repair your roof. And there's no actual claim payment, then that would not increase your rate. Now, if you have multiple claims where insurance proceeds are paid out, then certainly at renewal, that would increase your rate.
Okay.
Mm-hmm.
So one of the other things that came up was there was conversation regarding a new NAIC model that came out. We talked offline about this earlier. Gretchen, you mentioned you are learning a little about it, and we didn't want to talk too much about it because you're saying it's not law. Can you share a little bit about that real quick, and then we'll...
Sure. So you're speaking about the Forced Placed Model Act that has been, I would say, going through a process for several years now. And really what they're trying to do is just kind of come up with kind of a standard for lender-placed insurance, because there really hasn't been. So we're following it. I know Proctor has responded. We put in our view on what we would like to see, but I don't know that that is law yet. And really, I think it's kind of been kicking around since like 2012. So it's been a while. So it's something to follow, but I wouldn't hold your breath.
Awesome. Beth, we have a lot of seconds buyers on this call here as well. How is that different from first and seconds, and what should seconds do? And, how do they handle things? Sometimes they can't even find out the insurance policy's on the first or not. In general, what are seconds investors should be doing for insurance policies?
Really, not a whole lot different than those in the first position, because even if you're in the second position, you have the obligation to protect your interest in that asset. I would say that in a case like this, you would go through kind of the same process. You would need the first position person or the borrower to give you proof of insurance. You would need the ability to place coverage if they either won't comply with the insurance requirements or won't give you the proof that they have it. The only difference would be that the amount of insurance that you would purchase on that asset would be determined or could be determined by the fact that you're in a second position. So in that case, it would be an important conversation to have with your agent and say, hey, this is my position, what do you suggest? And they can go over with you what the options are, with the various forms that we talked about earlier, the different coverages, etc.
Okay. Gretchen, anything you want to add to second investors and those who maybe can't find out the homeowner had insurance, or if they do, and how to prove the first house insurance in place, what that process is and how to handle that, or how to file,
Yeah.
what level claim do you file or insurance policy do you have?
Yeah, seconds are tricky. Typically, there's an assumption that if there's a second, there's probably a first, and somebody who owns the first is probably tracking the insurance or ordering the forced place coverage. So typically, there's less risk on second mortgages. When we actually do outsource tracking for some of our clients, and we typically don't even track seconds. We track the first. And you can blanket the second. So you could buy a blanket policy to cover your seconds. Now, that only becomes, you're going to want to have a portfolio of seconds, not just one, but if you have a portfolio of second mortgages, you could easily blanket those and just not even worry about them.
Great. So I'm definitely going to start opening up this discussion to more general questions for those who are out there who may have a question. So feel free to start shooting them over. Shante and I will be kind of monitoring these questions and doing our best. What we do ask is that if you have a question about a specific situation that's not general, that we ask you to reach out to the investor or to the insurance and attendees here and bring that question directly to them. So there's a chat box in the webinar that you can just ask a question generally out there, and we'll go from there. I know that when things are going on in the insurance world, there's a lot of questions regarding how to handle things with the borrowers and whatnot. Have you guys come across something that was just unique or some experience you've had with investors that you can say, hey, watch out for this, or here's a gotcha that you've experienced? Beth, have you experienced something with investors or a general question that come up that we haven't covered yet?
Oh my goodness.
I have one.
Yeah, go ahead.
I don't know if anybody out there has experienced homeowners association liens and how they can supersede first mortgages even in certain states. That's something to watch out for. And that's another thing that's evolving over time, where these homeowners associations are they're just getting tired of not being paid their monthly dues. And so they're starting, many of the states, I think there's 22 super lien states, they now have laws protecting these homeowners associations. So you definitely want to be careful of that. If you become aware of an HOA lien, you're going to want to resolve that as quickly as possible. A lot of times the homeowners associations will work with you. So if there's a lien for, let's say, $10,000 because the borrower hasn't paid their HOA dues for some time, a lot of times the HOA will work with you. So they'll reduce it down to $7,000 if you pay it up, pay it in full. So, but you definitely do want to get those resolved because it will turn into a foreclosure. And in many states, even the first mortgage can be, expunged.
Wow. Awesome. Beth, most investors don't even think about FPI insurance when they're buying a note generally. How difficult is it to convert over to it? I know you have an online system that's awesome, right? We can file things. How difficult is it for us to start that process and cumbersome and getting through all the weeds of it? How difficult it is from your system and your experience with note investors to get that set up and get it working?
Oh, I don't think it's difficult at all. I mean, the process is an application and then, basically a report that gives us an idea of the properties and where they're located and the amount of insurance that is required for each one. Okay. Once we have that, we're able to get some quotes. Once we've agreed on terms, then we get the system set up. There's a blanket coverage in place between binding and getting the online system going. And then I typically will input the properties that are covered at inception, and then schedule a time with the investor to walk through the system. They can look at the properties that have been added, make sure that there are no issues, and get trained on the system at the same time. So it's a pretty straightforward process.
Awesome.
We had a question earlier I don't know. I don't think we touched on it. The question was asked if there are any statutes in regards to specific states regarding force-placed insurance. There's no, is there, we have investors who sometimes don't have the insurance information written out in the borrower's note or contract. So if there's nothing that states anything about insurance and the borrower maintaining it, is there some sort of common law protection for lenders to use or to obtain force-placed insurance?
There's all kinds of regulations regarding force-placed insurance, and I think a lot of that can be found CFPB. And
so it's not a state-by-state case, though.
Yeah, but I think what the question was, if it's not written in the mortgage document. And I don't know if it's not written and it's not a requirement of the mortgage document, I don't know that there would be anything to protect the lender. I don't know. I'm not an attorney. I don't know, but I don't think if that loan document doesn't say that they have to maintain insurance and that the lender has the right to force place it, that lender might be out of luck.
Yeah.
This kind of goes back to the thing we were talking about earlier. As investors, it's real important to do the due diligence. Find out what is in the contract, the original loan agreements. Find out what that wording is. Have somebody like Erin look over it. Another set of eyes that knows what they're looking for.
Yeah, most people don't understand it.
I'm sure there are some state regulations. In Florida, we're very homeowner protective, and which is why a lot, O.J. Simpson lives here, so he can protect all his your homestead residence and your inalienable rights to your property are not significantly regulated in this state specifically. In Georgia, I don't know that I've ever had the issue happen. I could, definitely look it up and see, but I think that's probably more of a case-by-case basis, and definitely state-by-state basis. You're gonna have to. There is no one answer for your entire portfolio if you're, doing these things nationwide. What you can have is potential limits on the amount of FPI potentially, the premiums specifically themselves. I know that one of the biggest defenses in Florida that people raise when there is FPI on a property is the fact that the borrower could have gotten, that insurance coverage for, a third of the price of what the lender-placed in policy is. And, there's arguments and defenses to that for sure, but making sure that that policy is in place and protecting the asset is, I think, it's more of it's a personal risk assessment. And just like life insurance or they mandate car insurance, but that's more from a personal injury perspective, more so than in a public policy perspective, more than, protecting the asset. In a home, it's different. You don't have homes driving down the street running into people. So I think that's kind of more where that comes from, from the mandating part of it. So I don't know that property insurance is necessarily mandated at the state level as much as it is by the lenders trying to protect their financial investment.
So we had a follow-up question regarding seconds. The Karen asks, if we don't have any insurance information, can one find out if the property is insured? And if so, how do we add our name to that policy?
I had heard rumblings years ago that LexisNexis was working on coming up with some sort of a database that would hold that information so that you could find out, let's say if your neighbor had insurance and if you were injured on their property, you could find out, who insured that property. But as of right now, I do not know of any central database where you could find out if insurance exists on a property. And even if you did know if insurance existed on a property, unless you're the owner of that insurance policy, you cannot add your name to the policy.
Right.
Now, you could, if you're the lender on that property and you know who the insurance is through, you could contact the agent. Let's say it's State Farm. You could contact them and say, I'm the mortgagee, I need to add a mortgagee clause, and they will do that.
Cool.
There's also, this is kind of like in the back door, but a couple ways that you can find out, especially in a performing situation, when the note is performing, generally speaking, the borrowers are going to be cooperative with you. So if you buy a performing second and you call them and say, hey, I'm your new lender on your second mortgage, I'm just interested if you have insurance, can you send me your deck page? They're going to do it. It's the non-performing people, or the people that are not complying with their obligations, that you're going to have the problem with. A lot of you guys get first payoffs. Like, what is the first mortgage payoff? Is there escrow included in that payoff? If there is escrow in that payoff that's been advanced by the lender, I can almost guarantee you there's a lender-placed policy on it. If there's an escrow balance, sometimes there will be somebody that will give you that information. They may not give you the carrier information, but they may say, you know, yes, it is escrowed for taxes and insurance, and we disperse them we dispersed them recently, or something like that. So your relationships are very important, especially between each other, you know, as far as, you know, first and seconds. You just got to be careful not to get into the nitty gritty and run amok of, the borrower protections for their financial information. So, but those are kind of a few good places to look to see whether or not that property is actually protected.
So Shante, I'll let you answer Patty's question regarding if there's an escrow account for the borrower, not forced place insurance, what kind of insurance do you need to buy for the borrower?
I don't think I'm understanding that question. Because if you have an escrow account, does that escrow account include insurance? Because escrow is a mix between taxes and insurance. So
I think I know what they're asking. So if there's an escrow account, there are some laws, I think it's the FPI or somebody, maybe it's a Fannie regulation that says if there's an escrow account, you have to do everything that's possible to maintain the preferred insurance on that property. So let's say their escrow account is $1 short, but you need to pay the preferred insurance. You go ahead and pay it. Now, as a lender or a mortgagee, you're not responsible for going out and buying them a preferred policy. They're responsible for keeping their own homeowner's policy or preferred insurance policy. If they happen to not have enough in escrow, then you can't not pay that preferred policy and then send them to lender placed. You can't do that. But you have no requirement whatsoever to go out and get them a preferred policy. That's their responsibility.
Yeah, I tell all investors that have that question that comes up at Madison that I speak to is that you are required, Gretchan's right, you are required to maintain their insurance. If there's a shortage in escrow, you'll get an email from my escrow department directly letting you know if there's a shortage. Of course, we're going after the borrower as well. Hey, borrower, you're short. But she's right, you can't let that insurance lapse and cancel and then take forced place insurance, enforce that as well. So
the follow-up question was, is that even for CFD?
CFD, from my understanding, and this is a question I get a lot that I don't always know the answer to. From my understanding, it's hard for borrowers to go to State Farm, let's say, and obtain their own insurance policy because they're not the deed owners yet. CFDs kind of work like car titles. So you don't get the deed to the property until you pay the loan off in full. So these contracts, a lot of insurance companies, from what I've been dealing with, aren't accepting. And then the lenders are going out and obtaining insurance and putting the borrowers as an additional insured.
That's true. We have a program, though. It's underwritten through our Lloyd's facility that it's a lot of our investors use this that are doing the contract for deeds. It's a no credit check. Anybody can get it full out homeowners policy that they can get for their contract for deed borrowers. in the borrower's names.
Okay.
So that does exist. The premium's higher, the risk is higher, but it is a policy that would be in their name. So just
Is that different kind of policy? Is that different from a typical forced place or?
Yeah, no, it's a regular homeowner's policy.
Okay.
It originated during the boom when anybody could get a mortgage on a stated income only. We've been dusting it off.
Patty, if you have any additional questions, follow-up questions, let us know. So, Drew, I think your question regards more of a liability about underground tanks, where FPI doesn't typically handle that. That's more of a liability question, REO question, which you could definitely ask direct offline to either one of them. These both handle different kind of insurance policies, where Beth is more of a brokerage, but you can go directly to Gretchan as well for insurance as well. We are getting towards the end of this awesome conversation. You know, if you have any more additional questions, we definitely will take a few more. But I wanted to, before we start wrap up too much, make sure that we share information. If you want to add your contact information in the chat box, feel free to do that. Whatever best fits you. I could definitely share it in an email. We're going to send up probably tomorrow with the copy of the video as well. But I'm very grateful for you guys to be joining me tonight on a Monday evening and share information that I had very little knowledge of. I'm going to probably be watching this or re-listen to this a few times just so I take notes to make sure my process is in place and do some things that are a little different.
I'll send my stuff out as well in the chat box, Dave, but I would appreciate, just because there were some people that fell off, if you would shoot it out.
Absolutely. Yeah, what I'll do is my follow-up email tomorrow when I send out the copy of the video from our YouTube channel, which we have a ton of videos there as well, is all your information so that people can reach out and go from there. I'm amazed by this field of insurance. And I'm kind of worried. Tennies, you don't need to share your email addresses or whatnot. It's more for you guys to reach out to the panelists and so they can give their information to you. Let me again make sure we get Erin. What states are you currently can cover foreclosures and handle things like that? And can you write addendums to any policy or any contract that we're dealing with?
Florida and Georgia are the two states that I currently work in. So I think what I said to you on yours is that I wrote it based on what Florida and Georgia law allow for, but that in the event that you were attaching it to like a California contract or something like that, then you would need to seek specific counsel from that area to make sure that it's not running amok of any of their specific laws or that it's enforceable in that state. So I'm happy to do that in either Florida and Georgia. And I also am licensed federally in those states too. So I do actually foreclosure and bankruptcy there.
Awesome.
And title work. It's really boring, but I do it.
Awesome. Well, ladies, I gratefully appreciate your time. It's amazing being surrounded by smart people that I can learn from, reach out to. If you have any additional questions, again, you can go through Madison to get your policy if you choose to, or you can reach out right to Beth or to Gretchan and get through an insurance policy for them. I know that Beth is an online portal. You can take things off very easily. And Gretchan also, you can reach out directly. There's a lot of knowledge about this space, and be sure to repeat, listen to us, put it on fast forward and get to the parts you need to take notes on. I have a ton of notes already I've taken on this. So, ladies, I appreciate your time. Thank you again.
Thank you, guys.
Thank you, Dave. Wonderful. Thank you for
Good job,
organizing.
Dave.
Thank you, ladies. Have a great evening.
You too.
Bye. Thank you.
Bye.
Bye-bye.